Hello and welcome to Securities Lending Saturdays. I'm Roy Zimmerhansl and I'm your host. Today I'm going to be talking about ESG and securities lending. So if securities lending is your thing or you're interested in ESG, then this is the place for you. So let's get to it. Welcome to the session. Today, I'm going to be talking about ESG. So let me get my handy dandy slide deck up, which is ready. And there, unsurprisingly, swamped with green. Okay, because that's what people think about. But of course, ESG is not just about green issue. The objective is to have something that is a catalog of fundamentals of securities lending, because this business is becoming more widespread, more global, and becoming more retail oriented, where people don't get the opportunity to get the training and education and information. So that's what we're here to do. Of course, we have lots of professionals that join, give me comments, tips, advice, suggestions, and sometimes even ask questions. Let's get to it. Let me stop waffling and start talking about something productive. This is week 21, spread out over 22 weeks. We're going to be talking about ESG at least this week and next week. And depending on how the timing works out, maybe even a third week, which sounds like a lot. But look, ESG is becoming an incredibly important issue for many, timely, relevant to people. And so we need to make certain that we address it to answer those questions and provide that information. Okay. We're going to talk about in today's segment, though, is we're going to be looking at the oversight aspects. So this is the big picture this week. Next week, we'll get into more granularity. And if we need a third part, then we'll talk about some recommendations, or we might tie in the recommendations next week. So talk about three big picture issues today: the view on short selling, securities lending, policy decisions, and then, of course, voting as a distinct policy issue. Remember, this is for informational and entertainment purposes only, so you always have to speak to professionals before deciding to take any kind of action. And look, these markets are only speak to professionals before making decisions that affect risk. And securities lending is a risk reward business. I've said many times it's a low risk business, but it is not a zero risk business. All this is about creating a money tree, hopefully, a money tree for all of us investors along. So first, what is ESG? So that stands for the environmental, social, and governance criteria that investors use when trying to analyze companies and assess whether they are worthy candidates of investment. So those are three really distinct issues. And many people think of ESG as just being green issues. And of course, environmental stewardship is a critical part of that, but it's not the only part. And what we actually also see is that there are different focuses that are often regional or local. So broadly speaking, you find that environmental issues tend to come up as more of a priority across Europe generally. In North America, you see the social issues. And by social, we're talking about gender, we're talking about diversity, we're talking about inclusion, is those sorts of human factors, if you will. So green is environmental factors, S is sort of the social issues, and then the G stands for governance. Now, almost everyone I talk to says we've always been worried about governance. And I suppose that's true. But what the ESG element of it brings in is there's the normal corporate governance. Is a company run? Do they have good long-term strategies? Do they compensate employees properly? Those sorts of issues. But then you add the E and the S issues on top of that, sort of broadens the criteria for what that governance embodies. ESG, the governance, even though it's always been a criteria, brings out more issues to focus on and specific questions, and also directly ties into securities lending and short selling. Before I go into the next page, we've got a comment here from a LinkedIn user. Hi, Roy, great webinar. A number of emerging markets have been saying that they would introduce securities lending, but haven't. How do you see securities lending becoming popular in the developing world? What can be done to encourage them? Can improving liquidity be used as a good reason for them adopting it? Wow, that's a video on its own, but it's a terrific question. Let me address a few points on there just as bullet points. So emerging markets, sometimes individual countries might say that they want to put in short selling and securities lending. And they might even enact legislation and regulation and taxation changes that enable short selling and securities lending. And so outwardly, that looks very positive. Now, if I was being cynical, I would say that I've seen instances where countries have done that only because having short selling and securities lending is an important criteria in order to be classified by MSCI and FTSE and Russell to upgrade a country's classification from maybe from frontier or equivalent to developing or equivalent, or from developing into developed. And the reason that those classifications are important is because you have many index trackers that will track those indices, and the frontier is smaller than emerging, and emerging is smaller than developed. So when a country gets upgraded into another index, it's likely that they're going to see more inward investment. And if the rating providers, or the classification providers, or the index creators, however you want to classify them, use short selling and securities lending as a criteria, and you don't have it, then you're not going to get upgraded. If you just enable it, then that might be enough to get upgraded, have that inward investment, but not actually implemented. So if I was being cynical, that would be some of it. Some of it is, look, it's difficult to do, particularly with things like tax regulation, because they can't just bring in a tax regulation that just covers securities lending and short selling activity. Almost all taxation is really pervasive. And what happens is they have to be certain that changes that they make to enable securities lending doesn't have an adverse, unexpected impact somewhere else. So it can take time to implement some of these tax regulations. And so some of it is time. Some of it requires things like netting opinions to be in place. So for netting opinions, what it means is that in the event of a default, it's predictable how a court would offset the obligations and the assets and the ownership positions of the borrower and lender. So those, again, are difficult transactions to put in place. I don't want to get off on too much of a tangent at the moment, but legally, that's a legal issue. So again, that has to be implemented countrywide. So there are numerous challenges to do that. So it does take time. And then, of course, there are successful countries that have implemented. It's a great question. Of course, as the question suggests, liquidity is clearly one of the reasons you do it, but that's not the only reason. There's price discovery. There's also the minimizing of extremes of highs and lows in a market. And again, that's all subject for a video. So thanks for that. Great. And hopefully I've added a little bit to that. And yeah, great idea for another video. Besides, just a quick comment. I'm part of the Global Principles for Sustainable Securities Lending, and it has a number of work streams. One of those key work streams is specifically about best practice in emerging markets so that we can help countries as they develop their infrastructure and give them guidance and principles and feedback and input. So very much a part of the focus. And I see that's a huge part of where the securities lending industry goes in future, is becoming more inclusive in a wider range of markets. Thanks for that question. Zach, great to see you. Thanks very much. Will there be a regulation responsible for banks? Yeah, look, diversity and inclusion is a fundamental issue. And I think not just securities lending, but literally everyone is struggling and challenging themselves and trying to move forward on this. So I think it's almost like ESG. One of the reasons that it's taking longer to implement is because people are thinking about it for the first time. And because we're just thinking about it for the first time, people are putting out feelers here and there and what works and what doesn't work. And of course, ESG is important, but maybe not as important as the bigger issues that are the human issues, the diversity and inclusion issues. But I think it's equally challenging. You have all of our history that has put in biases and practices, whether they're conscious or unconscious. So look, it's something we all have to be aware of and stay on top of. It's always great to get questions and comments about that as a reminder to say, how do we think about these sorts of things? It's a big consideration when we're putting together panels. It's an important consideration when even in the global PSSL, we try to make certain that we are reaching out to the widest possible community for input and participation in the work streams and as signatories and members of the group. But key watchwords for all of us. Okay. So that's a bit of a link now for those of you that are watching on replay on LinkedIn and Facebook. I've let it go on a little bit longer. I'm now going to, on the replay, this is the cutoff point. I'll just put up the YouTube channel very quickly again. He says very quickly. There you go. That's not all that quick, but there you go. So that's where you need to go to watch the replay or the full session. Again, I slightly edit these. I get rid of some of the ums and ahs and things like that. Okay, so I'll just clear that off. As I said, today we're going to talk about the oversight. To me, that's a little bit about, I was struggling with the word. It's a little bit the indirect and direct. So the indirect is what are the big picture issues that we want to look at and raise and discuss. Next week, we'll be talking about more of the direct on target items. So that's the actual practice of it being selection of counterparties and assets to lend and collateral and some other related issues. So we'll be talking about all of that. And also, as I said, I'll be making some recommendations, again, either next week or the following week. So that's how ESG links into securities lending. I remember the whole idea of these, as I said earlier, is that what we're trying to do is share information. So if you find these helpful, that's great. Please give me a thumbs up, or that helps more people see it and helps me get some support for this momentum to improve education and information. And of course, if you individually, please subscribe. So you get advised of subsequent videos that I produce. Still only one a week. My schedule just isn't allowing me to do more than that as much as I want to. Okay, let's get back to work. Enough of that. So what is short selling? What we're talking about when we refer to short selling is it's trading in a way that generates a profit if the asset that you're short selling drops in price. So everyone's heard of buy low, sell high. This is the opposite, although from a risk profile, it's not. It's sell high, buy low. So I'm going to sell something at 100 and hopefully buy it back when it gets to a lower price of 50 and I have a profit. Okay, now I talk about asset because there's been gold lending has been going on long before securities lending, arguably. Certainly at scale, gold was more active. Foreign exchange short selling is commonplace, always has been commonplace. So it's really any asset that you have, you can trade in this way, whether it's liquid or not, and the volumes and scale. Those vary by asset type and by security or by individual. But broadly speaking, it's that. Now, in order to do that, of course, as I've said before, if I sell you something and you've bought it from me, it's because you want to own it. And if I don't have it, how am I ever going to deliver it to you so that you own it? And how am I ever going to get paid for this, what I think to be a high price? How am I ever going to do that? And what I do is I borrow the asset, and then that gives me an obligation that whoever I borrowed it from, I have to return. Of course, just like a bank loan, often think of these things in the same way as you would a bank loan. I want to buy a car that I don't have the money for, so I borrow the money. Of course, the bank wants the money back at some point in the future. And if I don't give that back to them, they're going to take my collateral, which is the car. So it's not really all that different. And along the way, I pay interest. So securities lending is not really much different from that. But the different reasons that people do short selling, those are many and varied. And broadly speaking, I categorize them into three different areas. One is hedging. So think of hedging like an insurance policy. I'm concerned that some kind of freak accident might happen and my house might burn down. So I buy insurance in case that happens. I don't expect it to happen, but it might happen. If it never happens, you could say, Roy, you wasted all of your money on that insurance. Or I could say, I spent that money in order to have peace of mind. The way that applies to securities lending is if my portfolio is continually rising and continually rising, that's great. But I'm a realist and I know markets don't just go up. So if I'm concerned that my portfolio has now reached such lofty heights that there might be a short-term bump as the market corrects, and I might lose money on that, I might short some stocks so that if the inevitable happens, the market corrects and my core portfolio loses value, I'll still make a bit of profit on the insurance policy short positions. But that's not what drives my portfolio. What drives my portfolio is the core long holdings. Okay. So short selling there is an insurance policy, and you can describe that as a hedge. The other is arbitrage, where I look at two equivalent assets or similar assets, or some way where I can categorize them as being related. And I like one and I don't like the other, where I think one is expensive and I think the other is cheap. And so I might do short selling to take advantage of those kind of price differentials. Now, the one everyone hears about and everyone talks about and is all in the media is the directional one. It's just an out and out, I don't like this stock. I think it's overpriced. I think it's going to drop. So if you think of historically, that's been Tesla, and short sellers have been so far proven wrong. But of course, you have to remember, short sellers can trade long and short, closed positions, open positions. So don't just think that they go into a short position and stay in that position forever. Some do, but not necessarily everyone. And of course, the big examples this year have all been the meme stocks. So GameStop being the biggest example of that, or the most famous example. That's what gets covered. Melvin Capital has shorted, arguably the whole market has shorted more than 100% of the free float of GameStop. And so that's what in the media. But just be very clear, that is a high risk strategy, just that single stock, because the only way you can make money is if it drops. Most other strategies have some element of long and short to it, and you never make the absolute most. If GameStop goes from $150 to zero, you've made $150. That's great. If you have an offsetting position that loses money while GameStop is making that 150, it's not the absolute amount. Just like if you were long GameStop and it went from 150 back to its peak over $300, over $400, you would make money doing that. But if you had another position that was short and the market rose, you might not make as much. So most are kind of hedged or arbitrage positions. Directional is one that gets all of the press. And remember, short sellers don't all like each other and they don't all follow each other's strategies. They're diametrically opposed. So again, I have in a number of my articles on GameStop, I have said that I don't believe this is David versus Goliath and it's hedge funds versus retail investors. And we've seen all kinds of public evidence that many hedge funds made money because they were long GameStop. So nothing's ever quite as black and white as it might seem. All right. So what I'm talking about here when we are referring to ESG issues is always directional activity. Okay, that's what we're talking about here. The first complaints about short selling it occurred in 1609, where people were talking about manipulative practices. It led to a short selling ban for the rest of that century. So it's been with us for over 400 years. It's been controversial for 400 years. I think it'll still be with us in 400 years, and I think it'll still be as controversial then. Okay, so that's just life, and you have to get over that. There was a time when I was quite evangelical about it. I've just come to accept that some people will never think it's good. Now, what a key point of most of the regulation is related to securities lending and short selling is that if a short seller wants to take this short position, sell something that they don't own, it's important that they find a way to acquire that asset so they can deliver it to the other counterparty. Partly because that other counterparty, the buyer, expects to get it, partly because of the knock-on effect of what happens if they don't get it. If they never receive it and their objective was to hold it and then sell it again, you're actually now affecting multiple parties in the chain. And then, of course, the other element is if I'm a would-be short seller, and a stock normally trades 1,000 shares a day, it's likely that if I have to find a way to borrow it, I might be able to borrow 100 shares, maybe 200 shares, maybe even 300 shares, but I can't borrow 500 shares and I can't borrow 1,000 shares. And what that does is that impacts the number of sell orders there are on a market, and that avoids any kind of manipulation of stock price due to overwhelming sell orders when there's not enough buy orders. So again, I talk about that elsewhere, so I don't want to get into that too much. But one of the factors that regulators want you to do is make certain that you have a market tradable size that you can borrow and deliver to avoid systemic risk and price manipulation. Okay, so that's a little bit about short selling. I haven't done a short selling video. Let me know in the comments of wherever you are, whether you want me to do a video on short selling, just specifically on that. I'll be interested to see what you think on that. So just let me know. Now I'm going to turn specifically to short selling and ESG, but first, a word from my not sponsor, Coca-Cola. I need to have a quick drink because my throat is starting to give out. Okay, I'm back with you. As I said, with respect to short selling, we're talking about directional short selling when it applies to ESG. The historic role of short sellers, the directional ones, is that they try to uncover bad practice by companies or senior people in those companies. And these are people and practices that often are missed by regulators, they're missed by auditors, and they're missed by other investors. And so it's really short sellers and or investigative journalists that uncover these bad practices that gotta have that Coke. Absolutely. It's really short sellers and investigative journalists who are the ones that identify and popularize the challenges, issues, and questions that they believe exist for those names. Otherwise, these things wouldn't necessarily come. What I've put together here is just a list of some of the companies. And of course, these are some of the most popular names that have been uncovered by short sellers. But again, in each of these cases, it's an investigative journalist, a short seller that might have got information from a whistleblower, because of course, whistleblowers or former employees or employees that know of bad practices, really all important sources of information. But the ones that highlight it and publicize it are short sellers and investigative journalists. So those are just some of the companies. And why is that important? If it wasn't important and you had a pension fund and your pension fund was holding any of these stocks and these stocks were fraudulent and eventually would run out of money, be found out and go to zero, your pension money disappears. So as much as you might hate a short seller identifying a problem with a company that you own, what it does do is it does allow the company to look at that, challenge it if it's wrong, and then take corrective action. You know, the objective, I'm sure the objective of short sellers in many cases is they hope the stock goes to zero. But usually the only chance of that happening is if the company really is fraudulent or fake. And look, that's going to happen anyway, with or without the short sellers. Mostly it's to identify bad practice. And from a company point of view, they should, as much as they don't like it, use that as a trigger to say, is there any merit to what the short sellers say? And are there things we can change to make this company better? And if you think of the context of ESG, that's really what we're asking them to do with all of their policies and thinking. Take your company where it is today and move it to a better place in future. And if someone else helps you uncover issues or find out or think about issues in a different way, why is that a bad thing? Might be painful, but it's not necessarily a bad thing. Certainly not for the sustainability of your company. Okay. And that's important. So, what's the role of short sellers in this? I like to refer to it as economically motivated guardianship. So the economic motivation for a short seller, of course, is they hope the share price goes down and they buy it back cheaper and make a profit. And that's their incentive to put the time and effort, which is big, and their reputation's on the line going into these companies. So they need to be compensated for that, because if they aren't, why would they make that time and effort? And also, so that's one way. So the short selling one. Then, of course, you have the creation of ESG alternative funds. So there's lots of ETFs and mutual funds, and you can have separately managed portfolios that focus on ESG on the long side, but equally there's value there for alternative funds that can take long positions or short positions. An example here might be a carbon neutral fund. Okay, so there you go. I want to go back to a question raised by Zakia. Look, the reality is that I'm always surprised when a short seller uncovers a massive fraud at a big company. Some of these companies on this list were big companies. Quest was a big company. WorldCom was a massive company. Tyco was held by many people. Valiant was huge. Lots of these companies are big name companies. And long investors didn't find those problems. And if they did, if I own something and I find a problem, I might just sell out. I might just get rid of it before anyone else finds out. You don't see a lot of long investors, big institutional holders of these assets, identifying frauds at companies because it's against their own interests. So maybe they don't look too deep, or maybe they do find these things and then have a quiet word with the management. But what if it's the management that's fraudulent rather than a department or a division? So I'm always skeptical about long investors finding these things. And if a short seller finds something and it's held in your example, Zaki, in the HSBC pension fund, yeah, that's a bad thing for the pension fund. And this is particularly true when you talk about funds that are index trackers. And so if you look at a stock like Wirecard, that was in the DAX 40. So every investor that had a DAX ESG, a DAX ETF, a DAX-oriented mutual fund, DAX exposure as part of their overall global balanced fund. Look, you took Wirecard, fabricated all kinds of billions of dollars of fake numbers. That's a problem. And had Zatara Research and the Financial Times, had they not put their efforts in, you might still be holding Wirecard and think your portfolio is doing, when in reality, it would be perpetuating. As far as knowing what's in portfolios, yeah, funds do produce information from time to time. Those are snapshots. But look, they're going to hold more stocks than you could possibly take the time to investigate. I'm not certain that there is a solution, but this is part of the overall approach to better governance. And I think the more we encourage and enable short sellers and challenge regulators like the German regulators, why they didn't look into Wirecard more deeply, it's all about challenging that status quo to require them to be better investigators, be more thorough. Look at auditors. Auditors, where were the auditors? Every one of those companies are public companies. They all had auditors. What did the auditors check? Maybe all they checked was what the company employees gave them. Is that enough? Do we need changes there? So there's lots of people to look at. Barrett asked a question about short sellers in the event that CSDR comes in. So CSDR is another EU regulation that's been rolled out in various phases, I guess since probably about 2014. The next phase covers automatic buy-ins for failed trades, mostly in the bond space because equities are covered there. I think a bigger challenge is shortened timeframes. But so if we go from T2 to T1 or T1 to T0, some of these things might be challenges, but in the end, people will find ways around it. It's a great question. And whether the CSDR buy-ins get implemented ever or just delayed, ESMA has recommended, that's all still to be seen. But thanks for that question. But finally, I don't see how you get a proper ESG environment with a focus on governance and being watchful for greenwashing by companies or by investment managers that create products that claim to be green, but maybe don't really stack up when you dig deeper. And I also don't see how you manage your exposure in a long index. If you hold the S&P or you hold the FTSE, they have energy companies in there, which you might not on an outright basis buy a stock in there. So all of a sudden you're holding an index because it's a low cost way of investing, and that's a good thing. But now you're exposed to energy companies which you might not buy. If you have the alternative of getting a hedge fund which gives you carbon negative, can you now say, I'm not happy with holding it there, but I'm doing something on this side to offset that? And is economic offset really making a difference to the environment or whatever issue you're trying to address? I'm not sure. But taking a short position in a company that has bad employee practices, that doesn't have diversification and inclusion at its core values, I think that might be a more effective thing. If a company gets outed for being intolerant and too generic, then maybe that will cause action. So I think there's all kinds of layers of subtlety here. But my point is, without short selling, you can't have ESG. I don't see how it happens. Okay, that's my view. Let me know if you agree or disagree. I'm really interested. So as I say, all of this is new. All of these are new ideas. When I say maybe brilliant or maybe completely rubbish, or maybe most likely it's somewhere in between. And that's true of all of us. So we want open, wide-ranging input and commentary. If we talk about securities lending policy and governance, really the question comes down to lend or not to lend. What brilliance, what journalistic brilliance there. Think about it. If you are an investor, so Zaki, you mentioned your pension fund, and we should all be asking this about our own pension funds. Maybe I went from company A to company B, and company A pension fund didn't do lending. But my new company, they do lending. My last company, I'd never even heard of. I don't know why they agreed to do it. Why did they think it was a good idea? And my new one, it won't say we're not doing securities lending, probably in the material they give to me. And if I've heard about securities lending and I know it adds income to other portfolios, and remember, pension funds are one of the biggest lenders as a community in the world and make lots of money from securities lending, I'd want to know why my new pension fund isn't in it. So I really think that all funds that service the public should have a view on securities lending. It should have an explanation. We do it, this is why we do it and how we do it, or we don't do it, and this is why we don't do it. And that, frankly, is, I think, good governance. There's an opportunity here for us to generate incremental revenue. It adds a layer of risk. Do we think that this is acceptable or not acceptable? And an explanation why. Okay, so that's my thinking. If you're going to be doing securities lending, of course, you need to be thinking about things like which assets are you going to be making available for loan? What's your policy for voting? How do you choose who you deal with? What are the fees? Do you have any protections? What are the characteristics of it? And many investors will go into pooled funds, like I said, like mutual funds or ETFs or some kind of institutional pooled fund. It's all the same questions for those funds. It's just one step removed. So whether your pension fund is doing it or your pension fund is investing in an institutional fund run by a fund manager, all of those questions are still the same. And those if lending points will be some of the things I talk about next. Finally, voting policy. Now, remember, the objective of lending, or one of the criteria or characteristics of lending, is that an investor who enters a lending program wants to be in the same economic position as far as ownership entitlements after they start lending as they were before lending. So if they're entitled to dividends or interest payments, if they're entitled to warrants or rights issues, if there are stock splits, if there's anything that attaches to being an owner, you want to get that. And that makes sense. But voting, of course, doesn't have an economic value. You can't tell me what the value of me voting at the company's next annual meeting is. And so a borrower can't replicate that. And of course, they can't vote on your behalf because borrowers usually borrow stock because they've got a short sale, which means they're delivering it to someone else. So if I lend it to you and you've sold it to someone else and I say, can you do me a favor and lend and vote the stock this way for me? You'll say, I can't really do that because I don't have it anymore. So the real challenge then is for an investor that has chosen to lend, do they vote? And there's all kinds of different approaches. So there's no one right way. You can say, I have the legal right to always ask for my stock back so I can vote it. So I'm going to do that. I'm always going to ask for my stock back. And in a country like Japan, that's typical practice. Institutional investors always ask for their Japanese stocks to be returned to them in order for them to vote at every annual meeting. Okay. Or at least be on the company register for that meeting. Then you have some investors who say, you know what, my holdings and my influence through voting in many stocks will be so small that I, as an investor and my stakeholders, my clients, wouldn't really get any value out of exercising our vote. Where we get better value is from collecting more lending revenue, because that directly benefits us. So I'm not going to vote ever. I'm too small. So I'd rather have the money. And then you're going to have people in between who say, sometimes we want to make certain that we vote because it's a critical issue. So even if I only have one share, I'd rather vote that one share than not at all. But there's going to be other times where it's a routine series of issues at an annual meeting. And so there I'm going to take the money instead. So never vote, always vote, somewhere in between. All right. And you need to think about that. And that's the challenge. So the bottom line is that you can have a situation where voting coexists with capturing lending revenue. And as I said, I'll talk about that in future. Just a quick thing again, just on courses that we do, we have the free primer, and we've had a bunch of people sign up this week. So if you're watching and you've signed up, hopefully that this course I'm still recording. So maybe in the next couple of weeks, we'll have this sort of linkage between the capital markets and securities lending and really trying to tie the two together at an introductory level. And then there's, of course, the Big Daddy, which goes into quite a lot of depth on securities lending and has CPD credits and is both these are paid for courses. The primer is a free course. This one is the introduction course that's way underpriced, or you could say it's great value for you. Have a look at that. Okay, to summarize, we'll wrap it up. This is one of the longer videos, so my apologies if it's taken more of your Saturday than you planned. 3 different issues in terms of ESG and securities lending. Number one, short selling can't operate without securities lending. I've talked about why I think short selling is really a critical part of ESG. And since short selling can't operate without securities lending, you need securities lending and short selling, because ESG can't be really fully functional without short sellers. And so when you see funds that aren't lenders, there is an element there that says then you're not making your shares available. You'd rather just hang on to those and not allow them to be used for this sort of good governance and guardianship over ESG issues. I would challenge those investors as much as those investors challenge others who do lend. And again, I think every institutional investor should have a policy on securities lending, whether they vote or not. And then finally, voting is obviously a critical part of being an owner of an asset, and you need to focus on that. And that focus needs to reflect what your institutional investment objectives and criteria are. So that's it. Thanks very much, I think. Yep, that's it. So next week, part 22, we're going to be talking about ESG. It's part 2 of the ESG session, maybe part 2 of 2 or part 2 of 3. We'll find out next week. But I hope you can join me. Thank you very much for joining me today. Have a great Saturday. Have a great weekend. Have a great week. And I'll see you next week. Thanks and goodbye.